President Donald Trump just unveiled plans to cut taxes on every single taxpayer making $150,000 or less. Now, this is some pretty crazy news. We're going to roll the clip and then break down all of the economic impacts of this, as well as how likely this is to actually get through and what the reasons are behind taking some initiatives like this. But first, this is a crazy development. Let me know what your thoughts are down below in the comments, whether or not you think this is a good thing, or if you think this even has an ability of getting through and actually coming to fruition here. So before we get into all of this information, guys, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And don't forget to subscribe and turn on notifications so you never miss another video like this. But let's roll the clip.
His goal is to have external revenue. You know, the way I think about it, we all are so used to paying taxes. We're so used to it. We have like Stockholm syndrome. You know, don't stop the Internal Revenue Service, God forbid. How about this? The rest of the world leans on our economy, breathes off our economy. Not only is our economy $29 trillion GDP, but we consume $20 trillion a year. We are the buyer of everybody's stuff. We buy everybody's stuff. So who's more important? The people who sell stuff or the people who buy stuff? So we are the buyer of everybody's commodities, products, goods and services. Everything comes from us, right? Let them pay a membership fee. We all understand that model. Let them pay. How about we, you and I, and every single person we know pay less? How about no tax on tips? How about no tax on overtime? How about no Social Security? How about all those things? These are the kind of thoughts that will change America. I know what his goal is. No tax for anybody who makes less than $150,000 a year. That's his goal. And that's what I'm working.
So you guys heard it right there. The goal of the Trump administration is to have nobody making $150,000 or less every single year paying taxes. Now, in order to accomplish this, obviously, there's going to need to be some sort of replacement of that revenue, and Secretary of Commerce Lutnick, in that interview there, did cite a sort of a membership fee as his goal to how to kind of balance out the effects of not having a lot of that tax revenue, which we're going to cover, coming into the government every single year. Now, I know a lot of you guys at this point, especially after watching that interview there, are probably feeling maybe a little bit emotional or saying, okay, these are my political views and this is not something that I agree with. Well, my job here is to look at the numbers and understand whether or not this could be a positive outcome for the economy or a negative outcome for the economy, just looking at the numbers. Now, if you want to make your voices heard and debate some of these, you guys feel free to do it in the comments down below. But let's start at the high level here, break down some of these concepts so that you can get a better picture of exactly what would happen if something like this were to get enacted. So in 2022, approximately 93% of Americans aged 15 or over earned less than $150,000. Now, not all of those people are going to be paying taxes. And of that 93%, we have about 130 million people making $150,000 or less per year that are included in the tax base, meaning that they file returns and are part of the income tax system. So that is a significant amount of people. And how much of that tax are they paying every single year? Well, according to all of the available resources out there right now from the IRS, the census, that yearly number is approximately $650 to $700 billion in federal income taxes. That is approximately 30 to 33% of all of total federal income tax getting taken in by the government every single year. Now, when you look at these numbers and compare it to exactly what was actually given out during a lot of the stimulus during the pandemic, well, these people would be receiving approximately, or being able to keep, around $5,000 to $6,000 per person that is filing these returns every single year. Now, when you compare that again to the total amount of money here, During the pandemic, there was about $814 billion given out towards stimulus checks. And when you compare that to the yearly number that people making less than $150,000 would save total of $650 to $700 billion, well, in a year and a couple of months, you would be able to have some of the similar effects to the consumer that those stimulus checks had back in 2020. Now, you might be thinking to yourself right now, STV, wouldn't this just cause prices to skyrocket and inflation to soar just like last time? Well, it could, but inflation as a whole is here to stay, and the consumer is really struggling right now. And we have a couple of different metrics to showcase this. I know a lot of you guys have probably been sitting over the last year and thinking to yourselves, why are all of these talking heads in the media or all of this economic data coming out and saying that things are good in the economy, but you are not feeling that personally? And there are many, many different reasons for this that we're going to cover right here. The first is retail sales. So retail sales represents a key macroeconomic metric that tracks consumer demand for finished goods. Consumer purchases of durable and non-durable goods are compiled in the report, but the most important part here, guys, is the takeaways from what you can get from the retail sales report. The retail sales report helps analysts and investors gauge the health of the economy and any inflationary pressures that may exist. And when looking at some of the most recent data of retail sales, this is falling off a cliff. The other thing that we can look at here, guys, is Michigan consumer sentiment. Obviously, this is going to measure consumer attitudes towards the economy, personal finances, business conditions, and buying conditions, providing insights into consumer confidence and potential spending habits. Think about it like this. If the consumer is feeling really good about the economy and the overall financial situation that they are in, well, then it's more likely for them to go out into the open market and start purchasing things. That's going to enable some more growth, some GDP growth, and the overall expansion of the economy, which again can be reflected in markets. If they don't, or they expect inflation to be rising, well, there's a lot of interesting things that can happen and some self-fulfilling prophecies that can occur. Think about a rational thinking human being. If they think the prices of goods and services are going to increase significantly in the near future, well, then the next logical step would be for them to go to their employer and ask for higher wages. Their employer can either give them those higher wages and shrink their margins, and you can see a lot less profitability in these large corporations that is building up a lot of people's retirement accounts, or you can see mass layoffs. And as you guys can see on this consumer sentiment chart right here, consumers' attitudes towards the economy are moving lower, and that's for good reason. As I was talking about before in this video, that a lot of people were really feeling the effects of high rates and inflation over the last year and a half here, but the economic data was coming out and showing us that things were okay when under the surface there, they really weren't. Well, we have a couple of data points to support this. We just got this recent report out of Bank of America here that in 2024, the US had never been more government dependent for 85% of all the job growth. So think about that. All of the job growth, or the vast majority of the job growth that we saw last year, was in the government sector, and 33% of all spending. For those of you guys that don't know, a significant portion, about 30% every single year, of our total GDP is built up just directly from the government spending money. So think about this. We've gone from administrations that have been perfectly fine with spending money indiscriminately and hiring new people, whether or not they were being used for, let's say, an efficient use in the government. And now we are moving into a different administration where that is not the case. You can feel however the way that you want about that. You can make good arguments on both sides. But the fact remains that this administration is starting to change. We also have to deal with the fact that a lot of the prior data that we were seeing was, quite honestly, a bold-faced lie. When we take a look at the real wage growth that was reported to us in the third quarter of 2024, well, they told us that wages were going up real, again, so adjusted for inflation, 1.6%. So wages were going up at a rate 1.6% faster or higher than inflation. So they effectively said, shut up, don't worry about anything. We're not going to do anything to help you because we see that everything is fine. But that turned out to be a lie, and your wages were actually going down 0.1% there. So something needs to be done. We are moving from an administration in a market, in an economy that has been fueled by a lot of this increased and bloated government spending. Now, whether or not that money was being spent in good places, again, is not really up for debate in this video here. That is not what we're talking about and not what I'm here to talk about. The fact remains is that this environment that we are in is changing. So something is going to need to be done in order to help people that are obviously making $150,000 or less, because as I said before, inflation is going to be here to stay. And for those of you guys that don't know, that may be new to this channel or don't really have a lot of experience in analyzing economic data in markets, when inflation is moving down, like let's say that we saw an inflation reading that was 3% and now it's 2%, that doesn't mean that prices are actually coming down. It just means that prices are going up slower. That's all that means. So there's a couple of things that can be done. There can be some fiscal policy actions, which are going to be actions undertaken by the United States government, or there can be monetary policy actions, which are actions that are undertaken by the Federal Reserve. The only real thing that the Federal Reserve can really do to actually stimulate some of this growth coming back into the market here is going to be to lower interest rates. Now, we have seen this play out recently, that going into this year, the Federal Reserve and all of its board members were a little bit more hesitant at forecasting kind of what the market was expecting for rate cuts going into 2025. They really kind of pared back expectations and said, we're going to be really data dependent in what we do next. And they cited the inflationary fears of these tariffs. Now, as you guys all know, and again, if you're new to the channel, you may not know this, but the market actually isn't afraid of the inflationary pressures of tariffs right now. If they were, the bond yields would be going vertical and bond prices would be tanking. So that's really all the Federal Reserve can do, and that can be something that is coming. If we continue to see declining GDP, increased unemployment, and inflation starting to move to the Fed's long-run 2% target there, well, you definitely could see the Federal Reserve start to cut rates a lot more than expected. But is that really what's going to help out the average everyday person every single day? Well, it might have some indirect effects. Maybe their 401k starts to go up. Maybe it's easier for them to get a job or for businesses to expand. So a lot of these, maybe people in mid to upper level jobs are able to get raises at their current place of employment. But if you really think about it, if all of these households were to have every single year an additional $5,000 to $6,000, do you think that's going to help people at, let's say, the middle to bottom end of the totem pole here? Or do you think that rate cuts are going to help? Because that's really our only two options here. Without spurring massive amounts of inflation and the Federal Reserve and the government coming out and printing money to stimulate things again, if we end up in a period of declining growth and risk a recession. So that's really the main point of this here, guys, is, okay, when we look at the data as a whole, this plan that we have in place, if accomplished, because again, right now, we don't know if this is actually going to go into effect, if accomplished, is probably going to give a lot of people a decent chunk of money that they can use for whatever they want. Maybe they want to support their investment portfolio. Maybe they're struggling right now, and that $5,000 to $6,000 is going to help them go out and buy groceries because prices have already increased so much because of all of the reckless spending that the two last administrations have undertaken. So that is really going to wrap up this video here, guys. I kind of want to leave you with that question, is what's better? Do you think the Federal Reserve and cutting rates is going to help things out a lot more than actually being able to let people keep more money in their pocket to go spend in the market or to do whatever they want to with? So that is going to wrap up this video, guys. If you did enjoy, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn about these types of concepts, the market, the economy, and everything of that nature. So until next time, guys, I will see you. Have a great rest of your evening, your morning, whatever your time you're watching this. Peace.